Every country insists it's different. Every government promises that this time the pain will be controlled, the risks are manageable, the markets will calm down. In the mid-1990s, Russia told the world exactly that. The Soviet Union had collapsed. Capitalism had arrived almost overnight. Foreign money was pouring in, and Moscow's new technocrats stood in front of microphones and swore they had everything under control. There were charts, plans, acronyms, and international endorsements. Western advisors praised the reforms. The International Monetary Fund approved loans. Investors flew into Moscow, sat in glass office towers, and convinced themselves that they were watching a new era being born. And for a brief moment, it looked like the story might be true. Then, in August 1998, Russia woke up to a brutal reality. Its government debt had become unpayable, its currency peg had snapped, its banking system was collapsing, and the same country that had just been welcomed into global financial markets suddenly became a byword for default and devaluation. Investors lost fortunes. Ordinary Russians lost their savings for the second time in a decade. And the rest of the world learned yet again that the line between stable and broken is much thinner than anyone wants to admit. This is the story of how a nuclear superpower defaulted on its debt and devalued its currency in the same breath, and why the pattern behind Russia 1998 never really went away. Collapse isn't rare. Collapse is the rule. The real question isn't whether financial systems fail, it's how they fail, and who ends up paying for it when they do. We like to think of money as something solid, a salary arriving every month, a bank balance on a screen, a national currency printed with important faces and serious symbols. But in reality, money is a story people agree to believe. Debt is that story written into the future. And exchange rates are simply negotiations over how much your story is worth compared to someone else. In Russia, in the 1990s, all three stories, money, debt, and the currency itself, were rewritten at once. To understand how a country that possessed nuclear weapons, vast natural resources, and a population of more than 140 million ended up defaulting on its domestic debt and torching its currency in the span of a few days, you can't start in 1998. You have to rewind to the collapse of the Soviet Union, to the moment an empire tried to jump from central planning to free markets faster than its institutions and its people could handle. In 1991, the Soviet Union dissolved. A system that had controlled prices, production, and trade for decades simply disintegrated. What replaced it was not a gentle, gradual transition to capitalism, but something much more violent: shock therapy. Prices were liberalized almost overnight. State subsidies vanished. The old command economy wasn't carefully dismantled. It was blown apart. Previously, state-owned assets, factories, mines, oil fields, ports, were pushed into privatization through rushed auctions and insider deals. A small group of well-connected men acquired assets worth billions for a fraction of their value, while the majority of citizens watched the ground shift beneath their feet. This is where the oligarchs were born, and where the average person learned a bitter lesson. In a transition, wealth doesn't disappear, it moves. As the old system collapsed, hyperinflation roared through the early 1990s. Prices didn't just rise, they exploded. Savings that people had built up over decades simply dissolved. In 1992 and 1993, inflation rates hit triple digits. Pensioners who had done everything right, who had saved in state banks, suddenly found that their life savings could barely pay for groceries. The ruble became a symbol of chaos, not stability. So when the new Russian state tried to build credibility in the mid-1990s, it understood something very clearly. After hyperinflation, people do not trust paper money. Printing more rubles to pay bills was politically and socially toxic. If Russia wanted to attract capital both domestically and from abroad, it needed to offer something that looked safer, more respectable, more modern than simply running the printing press. It turned to bonds. In the middle of the 1990s, Russia began issuing short-term government securities called GKOs, treasury bills denominated in rubles that paid high interest. On paper, they looked like a smart solution. Instead of monetizing its deficit and causing more inflation, the government could borrow from the market. Investors could earn very high yields, the ruble appeared more stable, inflation fell from hyperinflationary levels into something closer to normal, at least compared to the early chaos. In reality, the GKO market was something else, a gigantic refinancing treadmill. The government issued short-term bonds with double-digit and at times near triple-digit interest rates. It used the proceeds not to build roads, schools, or productive industry, but to roll over old debt and plug a chronic budget deficit. Each new auction paid off yesterday's promises and created bigger ones for tomorrow. This created a familiar pattern. New debt was used to pay off old debt at ever higher yields in a currency that was being kept artificially strong. Foreign investors saw returns they couldn't dream of in U.S. Treasury bills or German bunds. They borrowed in dollars, converted into rubles, bought GKOs, and told themselves that the extra return justified the risk. As long as the ruble stayed stable, they were making a killing. And that was the key phrase, as long as. Russia's GKO machine depended on three fragile conditions. It needed foreign capital to keep rolling over the debt. It needed oil prices high enough to support the budget and provide precious dollars. And it needed confidence in the ruble's exchange rate. By 1998, all three of those pillars were starting to crack. After the chaos of early 1990s inflation, Russia tried to impose discipline through the exchange rate. The ruble was kept in a managed band against the US dollar, a kind of soft peg. This peg was supposed to send a message: we are serious, we are modern, we are dependable. To international investors, a more predictable ruble made Russian bonds easier to model and easier to sell internally to risk committees. To Russian citizens, it suggested that the worst chaos was behind them. But holding a currency band is like promising to defend a castle with a finite stack of arrows. If enough people doubt you, they'll keep attacking the walls until your quiver is empty. To maintain the ruble band, Russia's central bank had to spend its foreign exchange reserves buying rubles whenever downward pressure mounted. At the same time, the government leaned on high interest rates to lure foreign money into GKOs, which helped support the currency. So the system looked like this. High interest rates attracted speculative capital. That inflow strengthened the ruble and made the peg look believable, which in turn made investors comfortable buying more debt. It was a closed loop of confidence. As long as investors believed in the peg, they kept lending. As long as they kept lending, the peg looked credible. But beneath the surface, the system was becoming more fragile. The economy outside of the financial markets was weak. Tax collection was poor. The state couldn't reliably extract revenue from the new big players in the economy. Wages and pensions often went unpaid for months. Many people resorted to bartering goods instead of using cash. This was not a strong foundation for a massive, sophisticated debt market. Then, pressure arrived from outside. In 1997, the Asian financial crisis exploded. Thailand, Indonesia, South Korea, countries that had also relied on foreign capital and soft currency pegs, saw their currencies collapse and their banking systems shake. Globally, investors suddenly rediscovered a concept they had happily ignored during the easy money years: risk. Emerging markets stopped being a magic phrase and started sounding like a warning label. Hot money began to flow out of riskier countries, and Russia was on that list. At the same time, oil prices slumped. For Russia, a country whose budget and foreign currency earnings relied heavily on energy exports, this was not a small problem. Lower oil prices meant fewer dollars coming in, less fiscal flexibility, and more strain on the reserves needed to defend the ruble. Inside Russia, the budget deficit persisted. Tax collection remained anemic. Corruption eroded confidence. The banking system, heavily exposed to government bonds, was vulnerable. By early 1998, Russia's situation looked increasingly dangerous. High short-term debt, a currency pegged above its natural level, shrinking foreign reserves, and increasingly nervous foreign investors. In a room full of gas, it doesn't take much to light a fuse. Under growing pressure, Russia turned to an institution that appears in many financial crises: the International Monetary Fund. In July 1998, the IMF announced a large support package, billions of dollars in loans, designed to stabilize the situation, reassure markets, and buy time. For a brief moment, it seemed to work. Investor panic slowed. Officials spoke confidently. They insisted that Russia would honor its debts, maintain the ruble band, and continue reforms. But the underlying math had not changed. Russia still faced a wall of short-term GKO obligations coming due. It still relied on weak tax revenues. It still faced low oil prices. Its banks still held massive amounts of government paper, meaning that if the state stumbled, they would stumble too. The IMF money could delay the problem. It could not erase it. When markets realized that the bailout did not magically turn insolvency into solvency, the pressure resumed, now amplified by disappointment. The bet quietly shifted from Russia might default to Russia must not default because too many people are exposed. That's not a comfort. That's a warning. When a system becomes too big to fail, it has already failed in another sense. It is fragile by design. On August 17, 1998, the illusion broke. The Russian government made 3 linked announcements that shattered what little confidence remained. First, it devalued the ruble and widened the exchange rate band. In plain language, this meant we can't defend the old rate anymore. Second, it declared a moratorium on some private foreign debts, signaling to creditors that they would not be repaid on schedule. Third, and most dramatically, it announced a restructuring of its domestic debt, the GKO obligations that sat on the balance sheets of Russian banks and foreign investors alike. That word restructuring was a polite way to say default. Default and devaluation arrived together. The consequences were immediate and brutal. The ruble plummeted. Within weeks, its value against the dollar fell by more than half. Prices for imported goods soared. Shelves changed. What had been barely affordable became completely out of reach for many families. Banks that had loaded up on GKOs, convinced that government securities were the safest assets in the system, suddenly discovered that their balance sheets were full of broken promises. Many banks collapsed. Depositors saw their money trapped in frozen accounts or evaporate through bank failures and inflation. Companies struggled to pay wages or service their own debts. Trade ground to a halt as nobody knew what anything was truly worth from one week to the next. For ordinary Russians, this was not default as an abstract term in a headline. It was standing in line at an ATM that had no cash. It was going to a bank and being told withdrawals were limited or suspended. It was opening a pension statement and realizing that the numbers on the page no longer meant what they used to. Many had already lived through the hyperinflation of the early 1990s. Now they were watching financial trust collapse again, just when they had begun to hope it might be permanent. And the crisis didn't stop at Russia's borders. Russia's default sent shockwaves through global financial markets. One of the most famous casualties was an American hedge fund called Long-Term Capital Management. Staffed by celebrated traders and even Nobel Prize-winning economists, LTCM had made highly leveraged bets on bond spreads, using models that treated extreme market moves as rare anomalies. Russia, AS, default, and devaluation triggered exactly the kind of extreme move they had treated as nearly impossible. Suddenly, positions that were supposed to be safe melted down. Losses cascaded. Because LTCM had borrowed heavily from major banks and was entangled in many markets, its near collapse threatened to spread panic through the entire system. The U.S. Federal Reserve helped coordinate a private sector rescue to prevent a broader meltdown. A sovereign default in Moscow had turned into a margin call in New York. That is one of the core lessons of Russia in 1998. Once global capital and derivatives are involved, no crisis is truly local. When foreign investors chase yield in a country with fragile institutions, they don't just expose themselves, they weave that country's risk into portfolios and balance sheets around the world. A default in one corner of the map becomes a stress test everywhere else. Who lost in this crisis was obvious. Foreign bondholders who had rushed into GKOs for their intoxicating yields suddenly held instruments that were frozen, stretched out, or converted into longer-term obligations of uncertain value. Russian banks imploded. Depositors suffered. Anyone paid in rubles watched their purchasing power evaporate as prices jumped and the exchange rate collapsed. But beneath the chaos, another pattern played out. A pattern you see in almost every financial collapse. When a currency devalues sharply and asset prices crash in local terms, those who still hold liquid foreign currency or who own real productive assets find themselves in a position to buy what others are forced to sell. Shares in Russian companies, stakes in oil and gas firms, pieces of infrastructure and real estate, all of these could be acquired for a fraction of their previous dollar prices. For the unprepared, Russia in 1998 was ruin. For those holding cash, hard currency, and patience, it was a once-in-a-generation buying opportunity. Within a few years, as oil prices recovered and Russian growth rebounded from a much lower base, the economy began to look healthier. Some of the biggest fortunes and some of the highest returns for foreign investors were made by those who entered after the crash, not before it. Every crisis is a transfer. From late believers to early skeptics, from those holding paper promises to those holding something real, from passive savers to those positioned to act when others are forced to sell. Russia, 1998, feels dramatic and unique. A post-Soviet state, privatization chaos, oligarchs, IMF packages, a collapsing ruble. But if you strip away the names and the dates, the underlying script looks very familiar. A government runs chronic deficits it cannot sustainably finance. It relies on short-term borrowing at increasingly high interest rates. It pegs or defends its currency above its natural level to project stability and win political trust. Foreign capital chases yield, convinced the risk is worth it. An external shock hits, falling commodity prices, a global downturn, a regional crisis. Debt becomes unsustainable, reserves drain, confidence cracks. Then comes the hard choice. Politicians rarely campaign on defaults. Central banks don't like to openly admit defeat. So the solution is almost always some combination of what Russia finally did. Let the currency fall, change the terms of the debt, and allow inflation and time to do the rest of the work. Default is the admission that old promises cannot be kept as written. Devaluation is the decision about who pays for that reality. Domestic savers, foreign creditors, workers, importers, taxpayers, someone absorbs the loss. Russia in 1998 wasn't the first time default met devaluation. It wasn't the last. Versions of this story have played out in Latin America, in parts of Asia, in Europe, and in subtler ways even inside rich countries through inflation, negative real interest rates, and what economists politely call financial repression. The mechanics stay the same. Only the vocabulary changes. Why does this crisis, in a country that looked very different at the time, still matter today? Because the structure hasn't changed. Anytime you see a government running persistent deficits, financing them with ever-growing piles of short-term debt, defending a currency that looks suspiciously strong compared to its underlying economy, and insisting that everything is under control while reserves quietly shrink, you're watching a distant cousin of Russia, 1998. Anytime you see bond yields that look strangely generous for a country with weak institutions and political risk, you have to ask yourself whether investors are being rewarded for real productivity or bribed to ignore structural danger for one more year. Anytime global markets begin to talk about a borrower as too important to default, you should remember that people said similar things before 1998. Foundational assumptions always sound reasonable, right up until they meet arithmetic. The lesson isn't that collapse is guaranteed everywhere. The lesson is that the boundary between safe and unsafe is often just one lost piece of confidence away. For ordinary people, the takeaway is harsh but simple. Paper promises can change overnight, currency pegs can snap, banks can shut their doors. What tends to survive isn't a specific logo on a bank card or a particular number in a digital account. What survives is real productive value, resilient skills, and the ability to see through the illusion a little earlier than the crowd. Russia in 1998 was a warning written in rubles and default notices, a warning that high yields are often just hazard pay, that stability built on short-term borrowing and an overvalued currency is not stability at all. It's a balancing act on a knife's edge. Every government insists that its promises will hold. Every central bank believes it can manage the pressures. And every time a crisis comes, somebody discovers that the promises were conditional. In Russia, 1998, default met devaluation and the illusion met arithmetic. A country that had tried to outrun its past with borrowed money and a defended exchange rate discovered how quickly trust can vanish when the numbers stopped adding up. For those who lived through it, it was another painful chapter in a decade of upheaval. For everyone else, it remains a case study in what happens when a financial story loses its believers. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.